Crude oil pricing, as you can see on the chart here, we have been in this consolidated state between 65.22-ish to 68.38. We have been taking advantage, okay, of selling the high, buying the low, buying the low, selling the high, looking at Fibonacci levels to keep buying. And then we took a sell here back on down. But right now, price is very tricky here. And so we have to use a lot of caution with regards to what may or may not happen with crude oil. We're going to break down the higher time frames on this video. So make sure that you stick around to the end because we're also going to talk about some scenarios in case price gaps on Sunday. Now, here are some of the key headlines and key points that you should be aware going into your trading week for crude oil. Number one is IEA warns that global oil supply will exceed demand of 600,000 barrels a day, adding downward pressure on the crude oil prices. Number two, WTI remains below the 50-day moving average, which is 71.68 or so, and the 200-day moving average at 70.36, which I'll show you here in just a minute. So these moving averages are reinforcing a longer term bearish oil outlook. And then crude oil holds above that 66.72-ish area that I talked about, signaling a potential short covering rally. But again, resistance at that 68.22-ish area to 70.35 could limit some gains for those individuals. Okay, so let's start here on the weekly time frame. And again, just for reference, I am using the CL futures chart from the April 2025 contract. You should no longer be trading in the March contract. So whether you're trading on Forex or another contract, your pricing on the right might be different, but your price action should be the same. So we had 1, 2, 3, 4, 5, 6, 7 straight red weeks. And guess what? Last week, we eked out our first green week when it comes to crude oil. Now, I did want to bring in those moving averages that I talked about earlier, because I think this as a visual is just a reminder on really what side you should be trading on. We are clearly below the 200 and the 50-day moving average. So the yellow line represents the 50-day moving average, and the white line represents the 200-day moving average. As we drop down to the daily time frame, you can see here that again, we are kind of been consolidating in this area, but we are clearly still above both of those averages. Now, when we come to the 8-hour time frame, okay, we can see here that we are way below the 200, but we've come pretty close to the 50-day moving average on several occasions. And you can see here that this has been the price that we pointed out at the beginning of the video, where we've been trading between this 65-ish area to this 68 area as well. So we are kind of stuck in this area right in here. And so this is what we are going to break down on this video. So we're going to start by heading back to our daily time frame so we can begin to look at the analysis. This has been the high and this has been the low. So that is going to really be our playing field, in this case, our trading field in the meantime. This is where we look for opportunities. Now, I like to use a nice yellow line here for a visual, because understand that price is not an exact point, or a level is not an exact price, okay? It is within an area of value, or an area that we look for supply and demand. So now that we drop down into the 8-hour time frame, this is why we have been selling the highs, because you want to sell when price is high, and we have been buying the lows. Because I think the hardest thing for traders to understand is that you have to trade what you see in front of you, because you lower your risk when you have consolidation in areas like this. Let me show you an example, right? So if you were to take a short in this position here as it's nearing up here, you already know by looking at your left that your most recent high is this wick or this wick over here. So let's assume that we put our stop loss here. you have to understand that your risk is actually minimal because you're waiting until price gets at or very near these levels right in here. Now, in this instance, the reason why we took this short was because we also added a Fibonacci level. We took the swing high to the swing low, and we realized that price had rejected near that 88.6 area, which we love to look for, especially when it comes to crude oil. And if you haven't seen yet my Fibonacci video, I will link that video up above and also at the end of this video so you can watch it before the markets open. This will really, really help you with finding some of the awesome entries, especially on the higher time frames. And hey, don't forget, if at any point you are getting value on this video, hit the like button, share this link afterwards with your trading community, and don't forget to subscribe and turn on the notifications bell so you don't miss out on any important value. So this is the reason why these types of trades work out. To the flip side, if we taking a long in this position, okay, then we already know that our exit has to be below the lowest wick here plus your spread. And the goal is that we can go back up, hopefully, to the next level. Okay. And again, if we do an inverted Fibonacci from this swing low to this swing high, again, we saw here that price never closed below the 100. So anything near the 88.6, which was our entry, okay, gives us a much smaller risk because we know the 100 level is our exit, but we get a much greater return if it works out in our way. So until they decide to go higher or lower, we look for trades inside of this area here. Now, we just went over some of the fundamentals that may or may not happen with crude oil. And again, I think the fundamentals are important to know, but at the end of the day, when you hit buy or sell, the fundamentals don't matter. It's what price you get in and what price you get out. So with crude oil, we are extremely cautious, just like natural gas. So you want to use smaller lot sizing and you want to take profits off the table. I encourage our folks in our trading club that we secure profits after 20 to 30 points or 20 to 30 cent difference. And we enter two trades, same risk, but we want to take profits off the table and then we want to protect our trades. So if you need help doing that, if you're struggling, if you're trying to pass challenges, or if you're just brand new to this and you want guidance, a community can really help you. Check out my community at theprofessortrades.com. We would love for you to come on in. Check it out. You have nothing to lose. Come on in. And if you like it, you stay. We're at 93% retention rate for a reason. And if you find out that it's just not for you, you just hit boom, cancel membership, and you are done. For about $1 a day, you are going to get tremendous, tremendous value. So we can come here now and we're going to wait to see what happens. So let's talk about the possibility of price gapping on Sunday. Okay. So let's go ahead and label our call out here. Let's jump all the way down to the 1 hour. So we can clearly see here that this is where price closed on Friday. So this is the Friday close. Okay. So on Sunday, if price gaps up, which means it opens up here, right? That means that the difference between where price closed and where price opens, that's gap in the market, meaning there's a space in the market. If we gap down in the market, okay, which means price opens on Sunday down here, that same space that's created between the open and the Friday close is considered the gap in the market, and those gaps are usually filled. Now, if you've never traded gaps before, they can be very tricky. We have certain criterias for when we take gap trades. We trade gap trades every Sunday night live in the private community at 6 p.m. Not only crude oil, but natural gas, all the indices and the currencies as well. But we have a strategy. It works. But again, you cannot over lot size and you cannot over trade because gaps do not necessarily need to close within a few minutes or a few hours. They can stay open for 24, 48, 72 hours. Now, the good news on crude oil is that gaps usually close within the latest 5 days. Very few gaps remain open past 5 days. So again, a lot of them close real quick, but this means why you can't overtrade over a lot size. It's almost a better idea to have a separate account for just Sunday gaps because you already know that can turn into a swing trade. And many times it does. And we just add other positions and it becomes a very, very profitable trade. So keep that in mind when looking for gaps. So the outlook for the beginning of the week is going to be that we are going to wait for price action to give us some direction when it comes to where price is going to go. We don't trade Sundays unless there is a substantial gap. We wait for price to move Sunday and Monday to give us an idea of where price is going to go. On a smaller time frame, we can already see that we rejected there, okay? And we have a floor here on the 1 hour. So we begin to squeeze the charts and understanding that if we do close above 67.48, right? And you decide you want to be a buyer in the market, you should not buy until we have a price action telling us it's going to go higher than 67.48 and vice versa on 66.39. In the meantime, trading in this area could be very, very tricky because there could be no clear direction. Okay. Unless you're taking a Fibonacci level trade that you can justify, just like here, you can justify your entry because you know your exit would be the 100 price level, then that's fine. But otherwise, for most traders, this is where they lose money because they're trying to guess up or down, and the markets will move very, very quickly. That's why I personally like to let price move on Sunday and Monday, barring any gap trade. And then I look for direction. I look for areas of value where I can get the biggest return on my investment. And for right now, until proven otherwise, that's up here or near here, either one of these two levels, right? Now, we will take breaks of these smaller levels for smaller increments, like we talked about, 20 to 30 cent trades. But if you're looking for a bigger move, we need to see price come back up here and then see clear rejection to the downside with a bearish engulfing candle, or price come back to the bottom where we see clear price move up with a bullish engulfing candles, showing me a pattern that we are beginning to make another climb up. So we will be looking out for this Friday close here and see what happens with the Sunday analysis with regards to any gaps that may or may not occur. So in recap, the overall structure of crude oil is bearish. And this is why, for me personally, I've only been taking sell trades. I don't take any of those retracements up with crude oil because I don't want to get stuck. I want to trade with structure. I would advise you as well to trade with structure unless you know what you are doing. Okay. I would definitely have you trade with the structure until we don't see price close above that 68.55 area, right? You should remain bearish on crude oil. Keep up on the fundamentals that we talked about as well. And so follow the overall structure with crude oil. Again, if you have any questions, if you're in the YouTube community, if you just have the YouTube membership, drop them down below in the comments and I will get to you within 24 hours. And if you're in the VIP Trading Club, well, as you know, we'll share all of our charts and insights in there with our daily live analysis each and every morning at 9 a.m. Eastern Standard Time. Thanks for watching. Have a great rest of your weekend. And don't forget to like this video. Thank you.